The next education-related benefit is the deduction of student loan interest. So if you pay interest on a qualified student loan, we'll talk about what that means in just a second, you may be able to take a deduction as an adjustment to income. That's an adjustment, not an itemized deduction, so that means it's going to reduce your adjusted gross income. And adjustments, you may recall, go on part 2 of Schedule 2. The last adjustment we saw was the penalty on early withdrawal of savings. You don't get this benefit at all if you're married filing separately, or if you are claimed as a dependent on another person's return, or if you pay on a loan that you're not obligated to. So if you're paying off your kids' student loans and you're not a cosigner, you're not required to pay those, you don't get a student loan interest deduction. If you did pay student loan interest, you will get a Form 1098E, or most likely will get. If the institution that you borrowed from, whether it's a regular financial institution or government unit or the educational institution itself, if they're in the business of providing student loans, then they'll probably issue a 1098E. But a qualified student loan, I may be getting ahead, but a qualified student loan is any loan that you used 100% for educational expenses. In this case, educational expenses do include room and board. So if you borrowed money and used that money to pay for your dorm fees, or even if you use them to pay for an apartment off campus, that still qualifies as a student loan. So a student loan does not necessarily have to be something that's called or packaged as a student loan. It can be any loan that's used 100% for educational purposes. It could even be a credit card. Maybe you put your kid on as a authorized user on your credit card. You said you can use this for tuition, you can use it for food, you can use it to pay rent, but nothing else. Don't use it for the movies. And as long as they abide by those rules, then the interest you pay on the credit card is also student loan interest. As long as you also abide by those rules, you can't use that same credit card for anything other than, well, you can't use it for anything yourself. Student loan interest can even be a home equity loan. You can take a home equity loan and use that to pay your kids' tuition. And as long as that was used 100% for tuition and educational expenses, it would be a qualified student loan. But if you use part of it to pay off your credit cards and part of it to pay for your kids' tuition, it's no longer 100% and it does not qualify as a student loan. A qualified student loan can also be a refinance of a previous student loan. So if you took out like a debt consolidation loan and used it only to pay off previous student loans that you were responsible for, then that new loan is also a qualified student loan. But if you packaged your student loan together with some credit card debt and some other types of debts, that is no longer a qualified student loan. Now, some educational institutions that I know of will let you sign an affidavit saying that I'm only using this for qualified educational purposes, and that an institution would then volunteer to provide a 1098E for you. And the 1098E is only required if they receive $600 or more in interest. So you may have student loan interest to deduct even if you don't get a 1098E. And if you're using a credit card and you're using it properly and only for education expenses, credit card company is probably still not going to send you a 1098-E, but you can still take this deduction. So a qualified student loan is any loan that you took out solely to pay qualified education expenses. And you can take this deduction for the expenses of yourself, your spouse, or anybody who was your dependent at the time the loan was taken out. So it can take 10 or more years sometimes to pay off a student loan. And by that time, most of the time now, they have parents, they have to co-sign even to get a student loan for their kids. So even if you're paying or helping to pay off your child's student loan, and now they're in their 30s, that's still student loan interest, even though they're not your dependent anymore, as long as they were your dependent at the time they took the loan out. And also, you can claim student loan interest for certain people who weren't your dependents if they were almost your dependent, meaning that they would have been your dependent except they filed a joint return, or they would have been your dependent except their gross income was too high, which means you were supporting them, or they would have been your dependent except for the fact that you were someone else's dependent at the time. And you can't claim student loan interest, you can't claim something as a qualified student loan if it was a family loan. So if you borrowed money from your mom to help pay for your kids' your college expenses, that's not a qualified educational loan.
Now, what if they went to the bank and wanted to use the bank? Like, you might have someone before I needed $1,000, he didn't want to just give it to me, so he went to the bank, loaned it to me through the bank, where I had to pay him back monthly with interest.
Yeah, even if they set up some sort of like escrow at the bank to track and the interest and everything, that still would not be a qualified educational loan because it was from a family member.
Qualified financial institute.
Right, because the money didn't come from the bank, it came from your dad. And this section here is interest cannot be deducted from on a loan made from a qualified employer plan. That means is some 401ks and other related retirement plans will let you borrow from your 401k, and you have to pay back your 401k with interest, but that does not count as a student loan because really you're paying yourself back, so you're getting that money. It's just that you're getting it sometime in the future. Marianne took out a loan and used part of it to remodel her kitchen and part of it to pay her education expenses. That is not a student loan. The qualified expenses for purposes of the student loan are much broader than qualified expenses for purposes of American Opportunity and lifetime learning credit. It does still include tuition and fees and related expenses, books, supplies, and equipment. But it also includes room and board and transportation. I should mention, while I'm thinking about it, books, supplies, and equipment, if we go back to talking about the American Opportunity Credit for a second, books, supplies, and equipment only count for the American Opportunity Credit if they were required by the class. So if you buy additional study materials, that does not count. And similar to the American Opportunity Credit and the Lifetime Learning Credit, your qualified expenses have to be reduced by certain tax-free benefits you get. The definition of a qualified institution looks like it's the same as it is for American Opportunity and Lifetime Learning Credit. And we do have an income phase out. So if you notice on the quick finder handout that I gave you, student loan interest deduction is the third box in the top row. And the phase out range for married filing jointly is 155 to 185. For every other filing status, it's 75,000 to 90,000. So it's not quite exactly double, and that's because of how the rules on rounding go. But what that means is if you are below the lower limit, you get the full student loan interest deduction. Which again, I don't know if we mentioned it, the student loan interest deduction is capped at $2,500. If you're above the higher amount, you get no student loan interest deduction, and if you're between those two numbers, you get a partial student loan interest deduction. April paid $2,500 in student loan interest. She's single, and her AGI is 68,000, which is below the lower limit, which means she gets the full $2,500 deduction. Modified adjusted gross income is that term that changes meaning based on the context. In this context, it means your adjusted gross income, but you have to add back in some income that would normally be exempt from tax, which in this case is only about foreign income that you can exclude from tax. A student loan may be canceled either through Biden's plan or some other income-based repayment plan, or there's some other plans where if you work in a specific field for at least 10 years, then you get the rest of your student loan forgiven. If your student loan is canceled, then, well, normally debts that are canceled would be considered taxable income because you didn't pay taxes when you got the money and you're expected to pay it back out of future taxable income. However, if it is a qualified education loan, then you do not have to count that as income.